For months, the scariest story in all of finance had a name, and that name was the Strait of Hormuz. If you watched any money channel this spring, you heard the warnings. A narrow stretch of water between Iran and Oman that almost nobody could find on a map was suddenly the only thing markets cared about. Roughly 1 out of every 5 barrels of oil on Earth passes through that one choke point. And when Iran started threatening to throttle it, oil shot up, gas at the pump jumped about $1.50 a gallon, and the loudest voices online started saying this was the thing that would finally tip the whole economy over. Robert Kiyosaki's video calling it the war that would collapse the American empire pulled in nearly 1 million views in a matter of days. So here is the plot twist nobody had on their card. This week, the story completely flipped. The United States and Iran reached a deal to reopen the Strait of Hormuz, and the oil market reacted like someone hit the release valve. Oil has now crashed about 20% from its 2026 peak down to a 3-month low. Gas is falling for the 3rd week in a row. And the stock market, instead of collapsing, just punched up to a 15-month high. The thing that was supposed to break us turned into a quiet little gift. So let's talk about what cheaper oil actually does to your money, what it means for the Federal Reserve meeting happening this very week, and the one calm move that beats reacting to any of it. I'm going to walk you through exactly why one skinny waterway moves the entire planet's energy bill, how this new deal is dragging gas prices back down, what falling oil does to inflation and your interest rates, who really wins and loses when oil drops, and the honest catch that the cheering headlines are leaving out. This is the kind of plain English money breakdown we do here every single day, so if you want the news that hits your wallet explained without the panic, go ahead and subscribe. Now let's start with why this little strip of water matters so much. The Strait of Hormuz is the single most important oil choke point on the planet. Picture a narrow doorway in the ocean just a couple dozen miles wide, and through that doorway flows roughly 1/5 of all the oil and petroleum liquids the world uses. Tankers from Saudi Arabia, Iraq, Kuwait, and the Emirates all have to squeeze through it to reach the rest of us. So when there's even a hint that someone might block it, traders don't wait around to find out. They bid the price of oil up immediately, because oil is priced on fear of tomorrow, not just supply today. That's why a threat alone, with not a single barrel actually stopped, was enough to send pump prices soaring this spring. And jump they did. The national average for gas spiked to about $4.56 a gallon back around the 21st of May. Compared to before the crisis, that's roughly $1.50 a gallon extra coming straight out of your tank every fill-up. For a family with 2 cars and a commute, that adds up to real money fast. The kind of thing you feel at the pump, and then again at the grocery store, because everything you buy gets there on a truck that runs on diesel. The doom story wrote itself. Higher gas, higher shipping, higher prices on everything, and an economy supposedly walking toward the edge. And if any of this feels familiar, that's because we've watched this movie before. Energy markets have a long habit of doing this dance. A scary headline appears, somewhere in the world a pipeline or a port or a strait looks like it might get cut off, and the price of oil rockets up while every commentator races to call it the start of the next big crisis. Fear gets loud fast because nobody wants to be the person who said it was fine right before it wasn't. And then, more often than people expect, the worst case quietly fails to happen. The deal gets done, the supply keeps flowing, and the same price that spiked on fear comes sliding right back down once the fear fades. The Strait of Hormuz panic this spring fit that pattern almost perfectly, and you're watching the back half of it play out in real time right now. But here's the turn. The shutdown everybody was bracing for never happened. Instead of closing the strait, the United States and Iran reached a deal to keep it open, and the entire fear trade went into reverse. When that news hit, oil didn't just dip, it dropped hard. Brent crude, the global benchmark, fell almost 4% in a single move down to around $83.88 a barrel. West Texas crude, the American benchmark, fell even more, down about 4.5% to around $81. And it kept sliding. Just today, West Texas crude dropped almost 5% more, landing near $80.73 a barrel, a 3-month low. Natural gas eased off too, down to about $3.06. All told, oil is now down roughly 20% from its peak this year. So what does that actually mean for the one number you check without even thinking about it, the price on the big sign at the gas station? It means relief, and it's already showing up. That national average has now fallen 3 weeks in a row, from about $4.56 on the 21st of May down to around $4.12 by the 11th of June. That's a 44-cent drop in 3 weeks, and with the strait reopening, Analysts expect it to keep drifting lower. Here's a nice way to think about it. A drop in gas prices works like a tiny instant tax cut for regular families. Nobody had to pass a law, nobody had to fill out a form. The money just quietly stays in your pocket every time you fill up, and it lands fastest for the people who drive the most, the commuters, the delivery drivers, the families hauling kids all over town. Now, cheaper gas is the part you can see and feel right away. But the bigger story, the one that touches your mortgage and your credit cards, is what falling oil does to inflation. And this is where it gets genuinely interesting, because energy is woven into the price of almost everything. Oil shows up directly in what you pay at the pump, and indirectly in shipping costs, in airfares, in the cost of running a factory. So when oil falls and stays down, it tugs the whole inflation number lower with it. Economists have a slightly clunky word for that, disinflation, which just means prices rising more slowly, and slower rising prices are exactly what the Federal Reserve has been desperate to see. Which brings us to the meeting happening right now. The Fed's Policy Committee meets on the 16th and 17th of June this week, and they're going to decide what to do with interest rates. Going in, the market is almost completely certain, around a 99.5% chance that the Fed holds rates exactly where they are in a target range of 3.5 to 3.75%. Why so confident they'll just sit still? Because inflation, while cooler than it was, is still running hot, around 4.2% over the past year, which is above the 2% the Fed is aiming for. Kevin Warsh, who became Fed chair back in May, has kept the central bank in a patient wait-and-see crouch. They want to be sure inflation is really beaten before they start cutting. And this is the connection that gets overlooked, so let me make it simple. A sustained drop in oil and gas is disinflationary, and disinflation is the Fed's permission slip. If cheaper energy helps pull that inflation number down and keeps it down, it gives the Fed more room to cut rates later this year. And when the Fed eventually cuts, that's what slowly drags down the rates on the things that actually run your life, your mortgage, your car loan, your credit card balance. So today's cheaper oil isn't just about your gas tank. It's a quiet little nudge in the direction of lower borrowing costs down the road. That's a real reason to feel hopeful. But, and this is a big but, I have to be honest with you, because that's the whole point of this channel. 1 week of cheaper oil is not a trend. The Fed has lived through head fakes before, where energy drops, everybody relaxes, and then prices snap right back. So they're not going to cut rates this week just because oil had a good few days. Lower rates on your mortgage and your credit cards are a maybe later, not a this week. It's a door that just opened a crack, not a door that's already swung wide. Real quick, before we get into who actually wins and loses here, if these breakdowns are helping the news make sense, that is exactly why this channel exists. We post one of these every single day, taking the money story that's designed to scare you and turning it into something you can actually use. Hit that subscribe button so tomorrow's breakdown finds you. Okay, let's talk about who comes out ahead when oil falls. Because a falling oil price is never good news for everyone at once. It's a giant transfer, money moving from one set of pockets into another. When oil drops, the winners are pretty easy to spot. Airlines love it because jet fuel is one of their biggest costs. Shipping and trucking companies love it because diesel is what moves their entire business. And you, the everyday consumer, you're a winner too because cheaper energy eventually cools the price of shipped goods and makes that summer road trip or flight a little easier on the wallet. This is the exact opposite of the war trade everyone was making this spring. Back then, the smart money was betting on energy producers. Now that script has flipped. And that flip has a flip side. The losers when oil falls are the oil companies themselves and the energy stocks tied to them. When crude drops 20%, the companies pumping that crude make less on every barrel, and their share prices usually slide right along with the oil price. So if you've been watching your energy stocks sag this week while everything else rallies, that's not a glitch, that's just the other end of the same seesaw. One side goes up, the other comes down, and oil is the plank in the middle. Now, for most regular households, the winner column is where you actually live. If you're not a Wall Street trader with a basket of oil stocks, and most of us aren't, then falling oil mostly just shows up as your life getting a little cheaper. It's cheaper to fill the tank. Over time, it tends to be cheaper to fly somewhere and cheaper to get the stuff you order shipped to your door because the trucks and planes and cargo ships moving all of it run on fuel that just got less expensive. None of that makes for an exciting headline, but it's the kind of steady, real-world relief that adds up across a year, especially for working families who spend a bigger slice of their paycheck on gas and basics in the first place. So while the cable news version of this story is all about barrels and benchmarks, the version that matters for your kitchen table is simpler. The thing that was making your daily life more expensive just went into reverse. You can see that whole story playing out in the broad market right now, and it's worth a look because the reaction was the opposite of the doom forecast. As the deal eased fears about energy supply, stocks didn't crater. They rallied to fresh highs. The S&P 500, the index that tracks 500 of America's biggest companies, climbed to a 15-month high. The Dow rose too, and the Nasdaq 100, which is packed with the big tech names, hit a high it hadn't seen in about a year and a half. Cheaper energy means lower costs for almost every company that isn't an oil company, and lower costs tend to mean fatter profits. And the market was happy to celebrate that. It wasn't just stocks either. Bonds rallied at the same time, which pushed their yields down. That move got an extra push from a couple of other things landing the same day. A weaker than expected report on new home construction here at home, and cooler inflation news coming out of the United Kingdom. When you stack falling energy prices on top of softer economic data, you get exactly what happened. A market betting that the inflation fever is breaking and that calmer days might be ahead. It's a genuinely upbeat backdrop, and after months of being told the sky was falling, a lot of people are exhaling. So this is the moment where you might be tempted to do something. Oil's crashing, stocks are flying, surely there's a clever trade in here somewhere, right? And this is exactly where I want to pump the brakes with you gently, because the honest catch matters more than the cheering. Here's the other side that the happy headlines tend to skip. Ceasefire deals and diplomatic deals can break. They've broken before. A handshake this week doesn't guarantee a calm strait next month. On top of that, the big oil-producing nations, the group known as OPEC Plus, can simply decide to cut how much they pump in order to push prices back up and protect their own revenue. They've done it many times. And underneath all of it sits one stubborn truth. Oil is one of the most volatile markets in the entire world. It can swing wildly in either direction on a single headline, a single rumor, a single tweet. If you tried to trade this, here's the trap. You'd be making a bet on the next geopolitical headline, and nobody, not the smartest analyst on Wall Street, reliably predicts those. You'd essentially be guessing which way a coin lands, except the coin is on fire and being flipped by world events you can't control. That's not investing, that's gambling with extra steps. Which brings me to the genuinely good news, the part you can actually act on. You don't have to predict any of this to come out ahead. The calm, boring, time-tested approach handles weeks like this for you automatically. Keep dollar cost averaging, which just means putting the same amount into your investments on a regular schedule, no matter what the headlines are screaming that morning. When you do that, you're not trying to time the perfect moment. Some weeks you buy when things are pricey, some weeks you buy when they're cheap, and over the years it averages out in your favor without you ever having to be a fortune teller about Iran or OPEC or the Fed. Right alongside that, keep your emergency fund topped up. That cushion of cash that means a surprise car repair or a rough month doesn't force you to sell your investments at the worst possible time. The whole reason that fund exists is so that headline weeks like this one are something you watch with curiosity instead of fear. And then let the oldest piece of wisdom in investing do the heavy lifting. Time in the market beats timing the market. The investor who calmly stayed in their seat through the scary Hormuz headlines this spring is the same one sitting pretty at 15-month highs today. The folks who panicked and bailed when everyone was shouting about collapse, they're the ones who missed this rally entirely. And honestly, that's the lesson hiding inside this whole rollercoaster. For months, the story was that one narrow waterway was going to sink the economy. Then a deal got signed, the fear evaporated, gas started falling, and the market climbed to new highs. The scary version and the happy version were both just headlines, and headlines flip overnight. Your plan shouldn't. The people who win this game aren't the ones who guessed right about the Strait of Hormuz. They're the ones who built a simple plan and stuck with it while everyone around them was busy panicking and then busy celebrating. So take the win that's actually in front of you. Enjoy the cheaper gas because that's a real raise showing up in your budget right now. Quietly root for that lower inflation to stick around long enough to bring your borrowing costs down later this year. And keep doing the boring, beautiful thing that works in every single one of these news cycles. Invest steadily, keep your cushion, and give your money time. Because the biggest secret in all of finance is that you were never supposed to win by predicting the next crisis. You were supposed to win by calmly outlasting all of them. And right now, with oil down, gas falling, and the market at new highs, calm is paying off beautifully. We'll see you back here tomorrow with the next one.